Welcome to Compass Global Markets weekly update. Well, it was all about the French election results. We saw the euro reach a 6-month high after the favourite, the independent centrist Emmanuel Macron, won in a landslide outcome, 65% against 35% against Marine Le Pen, which was the far-right candidate in France. It was much expected that Macron would win because he's the pro-Europe, the pro-establishment candidate. And what we've seen is euro now trading at close to 6-year highs. And it's on the back of really strong, rapidly improving Eurozone economic numbers. They've got a very positive current account surplus, and their first quarter GDP numbers came in at a positive 0.5%. Now we expect the euro to strengthen a little bit more over the coming weeks, especially after what ECB chief economist Peter Prayat mentioned. He said that he suggested rather the ECB may not wait until the asset purchase program expires in December before they raise interest rates, which means the next ECB board meeting, which will be in June, regarding their policy settings, they may start talking about timing for an interest rate rise, which will see the euro well supported. Elsewhere in the US, we saw April jobs growth quite solid at 211,000. The market was expecting only 185,000 new jobs. The unemployment rate is at a decade low of 4.4% in the US. That's primarily due to a pullback in the participation rate. Now, the Federal Reserve is not alarmed, it seems, by the weakness in US economic growth. Even though GDP first quarter growth slumped to 0.7%, they're watching it with rose-colored glasses. They see this move as a temporary move only, and a June rate hike now in the US is fully priced in. So the market expects a 0.25% rate hike in June. However, the risk is they'll wait another 1 or 2 months. There is no meeting for the Fed in August, so if they wait till July or September, it will limit the upside on the US dollar. Because some of these negotiations, and we've spoken about it in the past, like the tax reform plans, could take several months to lift off. We've got the volatility index in the US, in the markets, in fact, at decade lows. The Dixie has fallen by about 2.5% over the course of the last month, and we've seen US bond yields become quite mixed. Now, if US bond yields start to fall again, it means that the economy is slowing, and the Federal Reserve certainly won't be raising rates in a slowing economy. So keep an eye on the US bond yields for some timing on interest rate moves. The Aussie dollar is trading at 4-month lows. Iron ore and base metal prices, precious metal prices have all been hammered. We've seen weakness in the economy. It looks like it's going to be a lower for longer growth story now for the Australian economy, and that's primarily due to subdued wages growth or lackluster growth in wages. China's manufacturing sector is also slowing. We've seen the Caixin index fall from 52 to 50. The weak credit conditions in China, coupled with the oversupply of iron ore, has seen the price of iron ore absolutely slump. It's fallen to sub $60 a ton and can fall another 15% in coming weeks back towards that $50 a ton level, especially as it's the 6th weekly decline in iron ore prices. In late breaking news, we've just seen April retail sales figures come out in Australia. It fell by 0.1%. It's only a marginal fall, but it's a negative number. And we've seen the Australian dollar now fall over 2.6% in the past week. It's moved from 75.5 towards 73.5 cents. We expect the Aussie dollar to find some support at 73.10. Beyond that, 72.50 is the next level of support, and that would keep the RBA very happy if that was to eventuate. However, we don't discount a fundamental move higher for the Aussie dollar back towards 75 cents on two major reasons. Firstly, the current account deficit in Australia is only 0.9% of GDP. When you compare the 5-year average, it's been around 3.5%. That's the deficit. And it's now only less than 1%. So if it moves into surplus territory, it bodes well for the Aussie dollar. Secondly, the Reserve Bank has recently upgraded its growth forecast for 2018 from that 3.25 to 3.75% upper limit, and that also will give the Aussie dollar some support in the weeks and months ahead. We've got the Australian federal budget released tonight. It looks like the main theme that Treasurer Scott Morrison will be discussing is housing affordability. The Aussie dollar could be susceptible further to the downside if Australia's AAA sovereign rating is downgraded. Now, there's only a slim chance that can happen because S&P have already placed it on negative watch, which means there's a 1 in 3 chance that we could get a sovereign downgrade, which could put further pressure on the Aussie dollar. Look, the other big releases this week on Thursday in Japan, we've got the March current account figures coming out. If the surplus comes in around about that 3.5% of GDP, then it's going to be quite yen supportive, US dollar weakness. And elsewhere in the US on Friday, April CPI figures will be coming out, and the market will be focusing on those numbers carefully because of to ascertain the Federal Reserve's rate hike expectations. I'm Tony Boyajian. Thanks for watching Compass Global Markets Weekly Update.